Hey everyone, this is John DeRelay, Head of Revenue Management Education at Wheelhouse, and welcome back to one of our micro market magnifiers. Today we're going to be taking a look at Panama City Beach. If you've seen our other videos on 30A, hopefully this one will be helpful as well as we kind of dive into some data and see what's going on in the market in January here as we go into spring and summer seasons. So for this first set, what we're going to look at is just a general Panama City Beach set. We have about 1,600 listings, and I'm looking at all the listings that have been over 60% occupied or more, so really have some measure of performance here, and also were available for at least half the year. And I have on our dynamic sets tool pulled up the trends, and what I like to look at is just the occupancies. Obviously, it's early in the year, and we would expect to start seeing bookings for the future as the booking window really hits now, but unlikely to see significant amounts of occupancy on the books. And that's kind of what we see here. Now, one thing to note, I think, is we're starting out the year, and it is the end of January currently. So as we look at this, we can see that January really hasn't come in the way that we would really like it to. If we look at last year, obviously occupancy is pretty low in a time period like this. But as January actualizes, we see that occupancy has really fallen short. As we look forward in February, we should see an increase in February, but it's also starting out pretty low. Now, we are almost at the point of where January is, so that's a good sign that we should reach a significantly higher point, but we're really not seeing the occupancy show up in Q1. I've been talking to a lot of folks across the Emerald Coast and the Gulf Coast of Alabama and Texas, and it seems like the Q1 snowbird season this year is really strained. Obviously, people don't have quite as much money. Snowbirds are particularly susceptible to costs, particularly costs when it comes to driving and traveling and all these other things. And those really add up and seem to be taking a dent out of this whole business sector. If we do a little deeper dive here into the occupancies at the daily level, you can really see where January and February are falling short here. It's really not quite coming in. We're not quite seeing these increases, although we do still see some dates of higher demand. This February 14th, 15th date is coming in quite a bit stronger. It may get where we want to go. Now, I think what's interesting is looking at the spring here. Spring last year was really volatile. From what I heard from a lot of clients and saw in their portfolios, people started their rates out much higher. The early booking really didn't come in, and spring underperformed a lot more than people would have expected. My hope this year is that people started their rate a little lower, but we're still seeing some dragging into the spring months. That early booking window has been behind from what I've been hearing from a number of clients. We're also expecting certain dates to really actualize differently. So we are starting to see some peaking up across different weekends. The weekend of the 11th, the 18th, and the 25th are all starting to pack on some occupancy. It already looks like a different trend in some ways than what we see here, where there's these big, huge spikes and these troughs. These troughs are not quite aligned the same way. They're also not quite as wide. So there seems to be a little bit longer stays. That may be a factor if people are starting their rates lower. Now, I think what's going to be really important in this spring segment is really early identifying what dates actually are selling. You really want to be priced in a way where you're starting to get information from the bookings themselves that will allow you to very quickly adjust rates in the areas that aren't selling and hopefully beat the market by stealing share if market occupancy is going to be low on those dates. It'll also tell you what dates you can raise the rate on. That's a big difference between now and COVID revenue management. COVID revenue management, things were really high. Lots of people were traveling. People started their rates high, and then you kind of fill in afterwards. In an environment where there's lots more supply, things are much more competitive. You don't know exactly what dates are going to be good. It's much better to start at a conservative rate position, let the consumer tell you where they want to book, and raise those rates up until you get to a point where you're maintaining your sales, and then really drop the areas that aren't booking so you can beat the market on share. What's also interesting here is this April time period. So there's something really big that we need to note in terms of differences this year to last year. Last year, Easter was pretty early, and it kind of attached onto that spring break time period. There was a lot of overlap there, looked really good, and that's probably where we see these big spikes last year. This year, Easter's moving much further away, And what's interesting is I'm not sure if this is because of the way people are pricing. I've noticed that over the past few years, holidays tend to book later because they are higher priced. A lot of people are confident that that revenue is going to come in, so they're willing to hold the higher price. That looks to be occurring here too, because as you look in those dates where Easter is, it's actually the lowest occupied date range in the time period. Now, if you're concerned about what the market is doing, there may be some really big opportunities there. People are probably willing to book early. The prices are just not right in the area. And if you start playing around with prices, you may be able to drive occupancy, which will give you more information, especially if you're concerned how the market's going to go. What's most interesting to me is this peak right here, this October 8th and 9th peak. This is obviously very different than last year. We're seeing this date start to peak up early, whereas last year it was one of the trailing dates, weekend dates across the market. This is a date to watch. If you're seeing this in your portfolio, there may be some opportunities here. Maybe because it was poor last year, you started the rate lower and the consumer is just shifting to where it is cheapest. But the fact that this date range is sticking up this year is really interesting to me. This next piece I want to look at is asking rate trends. So asking rates are the published rates that Wheelhouse is seeing on all the channels. Sometimes this will include fees, sometimes this won't. When we think about things year over year, we know there's been a lot of changes with fees. A lot of property managers are changing how their fees are embedded. So we do have to take this with a little bit of grain of salt when we're making assessments, but it is useful to look at it kind of at high level. We notice that already starting Q1, occupancies are dragging a little bit. The booking window is not quite looking as strong as we would hope it to be. And when we take a look at these generalities on asking rate, we can see that the rates are consistently higher. Now, we've probably built in a lot of inflation in our rates, but this is important to note that that occupancy response to higher rates should be a concern for everyone. So really paying attention to where you are compared to your historicals, particularly those historical bookings that were coming in probably in your primary window, I would say in for March, maybe in February, whatever that rate position is, probably want to be positioned closer to that. And if you're way higher, that should be a concern because we're already seeing that pressure on the occupancy side. And if your rates are higher, you're going to end up having to compete in the last minute. That's going to be at lower rate position, and you may end up with vacancy, which is something we're concerned about. When we look between 2025 and 2024, rates are pretty much higher across the board in the market. Keep that in mind because that gives you an opportunity. It might mean that you don't have to make very big changes to get some production in your portfolio and really see the bookings start flowing in. This next piece I want to look at is jumping over to the Wheelhouse market reports. We're just going to look at the overall market because this is a very high level trend. But I just wanted to point out that the lead time situation is pretty interesting. So if we look at this, last year, as we all kind of know, the lead time started to attrition a little bit in the market. Now, what's interesting to note is that that attrition in this marketplace was not super pronounced. Other markets saw substantial decreases to their lead time. This did shift a little bit, but when we look into 2025 for January, we're already starting to see that shift down even more. Now, keep in mind, this is the highest performing stuff. This does change a little if I look at everything. You see kind of the reverse trend, which is very interesting. It indicates to me that lots of people didn't change their rates in the short term. And so there might be a lot more vacancy in the market. But if we look at the top performers, they were willing to compete much more in the short term. Now, January is one data point. It's hard to extrapolate off of one data point. But what I would tell people here is let's just be conservative. Last year caught a lot of people by surprise. This year looks like things may not be that different, right? We saw some really early booking when different data platforms were talking about their early booking trends, but it's at the expense of ADR. So where we're seeing this early booking is when people are dropping their rates. And I think as we go into the spring in particular, it's a good opportunity to say, hey, I need to double check this. I need to be more conservative. I need to keep my booking window from attritioning too far. Now, a lot of folks I've talked to are still pretty confident about the summer. I think that's a pretty safe place to be. Once we get to the end of March, maybe early April, we'll start to think like, hey, do we need to start making some moves for summer? But the time is now for moves in March. If you haven't already been adjusting, if you're pacing behind, really consider dropping those and prioritize getting booking production and then adjusting the rate once you see a level of production that's going to put you on pace to get where you need to go this year. The next thing we're going to look at is we're just going to do a little bit of a deep dive into some of these Panama City Beach 4-bedrooms. For this 4-bedroom group, I did expand the rules. There are quite a few larger homes here, but there tends to be less. So we're really just looking at all of the available data from the Wheelhouse Sets tool and not really putting any restrictions on occupancy or openness. And that gives us a set of about 625 listings. Now, keep in mind, because it's such a large set, statistics are going to be pretty low here because not all of these are going to be super well commercialized. But we can start to glean some interesting things. For one, when we look at this, we can see that this January time period and February time period is particularly low. So that snowbird situation, not really coming through very strongly, especially if it's coming through OTAs. If you do have snowbirds, it was likely booked, 9 months to a year in advance, might have been return guests. Not to say there's not some coming in. We do see some production here, but the transient production of the snowbird is extremely low. When we zoom in here and kind of take a look at the spring, we do see some, this is where the bulk of the production is. We don't see like a lot of occupancy coming through March, but once we start to hit some of these March dates and even into some of these April dates, we start to see some of them peaking out above. And that's a good thing. We want to see production here. We do see that same trend of these 3 March weekends starting to pop up. We see a little bit of April, although April tends to be a little bit smoother in this group. When we kind of check the rate positions, we can see that there's still a pretty big range of rate positions, even in the winter. Now, this is 4-bedroom and above. We understand that people don't want to give away their properties, but some of this high-end rate position is pretty substantial for a low season. So if you take a look at this, the median of the set is around the high 200s and the high end is in the 450. There may be some opportunities here because we know that there are snowbirds booking. If you would rather have someone in and make some revenue for your owners than sit vacant, there may be a lot of opportunity here from a rate perspective itself. Now, obviously, this is going to be posted rate, so many of you do have long-term stay discounts, things like that, but putting in that posted rate is going to be pretty useful and getting it down because right now that low end of the range is barely under $200. So there's a lot of space there. Something you may consider doing is being a little creative here. A lot of people, have a long-term stay rate where you have to call in and get it, or, it's only available on certain channels because of the promotions. You might try something, which is if you're selling these on the OTAs, try putting in a longer minimum length of stay, but actually setting the rack rate to that lower value. That way people can just see right away that that's the rate. It's available everywhere. Something else I noticed in a friendly client's kind of strategy that he was talking to me about is they're having a really strong snowbird season and they're on the Gulf. And something they've done is really brought down the required length of stay. Now, they're not doing 2 or 3 nights at these discounted rates, but they're doing like 10 and 14. And they set the rack rate to target that. So if you go in and you're like, hey, on a 3-night stay, I guess I'm going to, I want $250, but maybe for a 14-night stay, I'd be willing to do $150. They went ahead and put in a 14 or a 10-night minimum length of stay, or maybe even a 7-night minimum length of stay. They set the rates to that lower value because while they may miss out on some 3 or 4-night stays, and they do leave rooms in the portfolio available for that, they're really finding much more long-term, that kind of like mid-long-term stay demand, and it's worth giving up a few reservations on the 3 or 4 night. And for the really clever people, you could also kind of reverse this, where once you get within like a week or maybe 10 days, you let that rate bump up to the 3-night rate and you open it up for 3-night stays. So something pretty novel there to see if we can just fill more occupancy in this time period. Now, before we move on, I just want to do a little deep dive into the occupancy. When we look at how last year ended, this is going to look really similar to the rest of the market that we looked at. We see these same peaks across these different dates in March. We see the same buildup in April. The biggest thing is that the difference between the bottom and the top is far more pronounced, right? The highest end dates are more booked. The lower demand dates are much less booked. And I think what that tells us from a strategy perspective is if you aren't seeing or expecting high demand, you really need to bring down the rates on those dates where there's vacancy because the market isn't doing well as a whole. And you're going to make more money by capturing share than by capturing ADR. What I would do now is find the dates that you think are going to happen in the spring. We can already see some indicators, the 11th, the 17th, the 25th, April 9th, actually, this whole end of April is looking okay. We're actually seeing the Easter bookings a little bit here, and the 2 weekends after Easter in the 4 bedrooms. So those are dates that you want to maintain high occupancy as long as you're maintaining production. But on everything else, bring those rates down. Last year, if you brought rates down within 2 weeks or within a month, double the time you cut that and start seeing if you can beat on share. You can always bring the rate back up. We have a little bit of time. We're running out of time for February. We're almost out of time for March to start making changes like that where you can bring them back up. But definitely as we look into April, it makes sense. And as you see these date ranges where there really just is lower occupancy, particularly on these weekdays, just get them down now. If you're overperforming on occupancy and pace and you're making that kind of money there, you can bring it up, but you're not going to feel bad if you were like, well, maybe I sold that weekday for 20% under, but it wasn't even sold last year. So just a quick recap. Panama City, we're in the booking window. We're seeing a lot of differences already for spring, and we should have a lot of learnings for last spring. Again, my suggestion is be conservative on dates that had vacancy last year. Use market data or your own data to identify which dates have demand this year and drop the other dates. Don't wait until the last minute. There's going to be a lot of other people waiting for the last minute there. The other thing is we're almost out of snowbird season. Snowbird season was really weak this year. I think that should push us to be more conservative going into the year and try to build rates up rather than start high and cut down. But start thinking of some different novel approaches to getting more business in that snowbird season, right? One, is the rate position too high? You have a lot of properties potentially that were vacant. What can you offer that would at least be acceptable to the owner, but actually brings money in the door? Two, I have a hunch that, the snowbirds are still going to exist, but instead of staying for 2 or 3 months, there's a lot of people who are willing to come down and stay for a week or definitely 2 weeks. So maybe build some experiments there to try to get those in early. And last but not least, we're still seeing ADRs crawl up. Obviously, expenses are going up for everybody. There's, all that inflation is getting built in, but we're seeing the resistance on the occupancy side. We're already seeing it this year. We saw it all last year. Look for those areas where either you are overpriced over what you've actually done historically, or where you think the market might just be holding too high, because those are opportunities for you to beat the market on pace, and that'll give you more time to make pricing decisions instead of just panicking once we get within 30 days. Anyway, thanks for your time. Bye.